Alright, welcome back to Startup Accounting 101. This is a video series for founders to understand accounting fundamentals for running a business. We are continuing through the financial projections template. It is available for free from score.org. Go to the template gallery and download the file. I'll have their link in the description below. This video we are looking at tab 7B, which is the income statement for years 1 to 3. But before we get into the income statement, the growth and the projections, we actually need to look at the type of income statement that's featured in this tab. Before, we only had the dollar values, like the total numbers. And so in this tab, we have those numbers in column C, but right next to it, we have a percentage. There's a calculation in column D, and what this percentage shows is how much of the revenue is going towards different expenses or line items within this income statement. And so this type of statement is called a common size income statement. So this type of statement helps compare the performance of businesses regardless of the size. So we have two different examples, common size examples. So on the left is the template, what you should have. And on the right is a sample company. So this is the ABC company. That way we can make some comparisons between the two. And with the percentage, we can compare different years. So in the template, we have these 3 years, and right next to it is the corresponding percentages. So within the same company, we could look at whatever time period makes sense to analyze. So we have year over year here, but it could be month over month, quarter over quarter. With these percentages, we can also make a comparison against a completely different company. So that's what we'll do here. We've got two different, completely different companies, and so we're going to compare against the two. And this percentage, we're able to see and analyze, what are the differences, why are the percentages different, and also why they're changing over time. So let's just get into the analysis. So I do have the formula and basically the calculation basis of how you would get the percentage. And any formulas or calculations in the video, I'll include it in the description below. But the percentage here is you take the line item divided by the revenue or net sales, and you times that by 100 to get the percentage. So that is why in both of the income statements, revenue is 100%. So for here, and these are just keyed in as 100%. So revenue over revenue is 100%. And the sample company is 100K, and our template we have 878K. So these percentages help to compare against two companies that have completely different scales of business. So this is almost 8 times as big as this sample, but we are able to make comparisons because of this percentage. So the first comparison is cost of goods sold. So the sample is 70%. So it's using 70% of the revenue is going towards COGS. Now, if we compare against our template, it's only 14%. But in the statement, in the sample statement, there's no labor or payroll in this section, which means that it has been included. So this line item has COGS and payroll. So to make a fair comparison, we would have to add the COGS and the payroll of our template just to be able to compare the numbers. Otherwise, it's just not a fair comparison right now. And in the template, only the major sort of different metrics and section totals have a percentage. So I'm actually going to complete this and give everybody a percentage here. So very similar, like all of the line items have a percentage. So I'm just going to quickly do that over here. I'm just going to do the first year. And so if we add together the COGS and the payroll, that totals 60%. So the candy bar business is a little bit more efficient up until like gross profit or gross margin. So they're left with 30%, and we over here is left with 40. So the difference would be 40% for gross margin. So when we get to any sort of subtotal, so we're talking about gross margin, operating income is EBITDA, earnings before taxes or EBT, and net income, these are all sort of subtotals. So the percentage of any of these key metrics shows the percent of profit up to that line. So we're down to gross profit, so that's 30% and 40% here. So the candy making business is a little bit more efficient up to gross margin. But when we come down to the operating expenses, here we have 3 different categories giving EBITDA of 15%. The template, we have a lot of different line items all totaling up and giving us an EBITDA of 14%. So what that means is that even though we're a little bit more efficient up here with COGS and payroll, the sample company is more efficient with the expenses, so it gives an overall EBITDA of 15%, which is higher than what we have. We have a 1% differential already. And then when we move into the interest expense, it's the same thing, just copied twice. So we have interest expense, and then giving us an EBT percentage of 13%. Our EBT is 11, so it's already a little bit even more efficient, the sample company. And then we're paying taxes, and at the end of the day, we have a net income of 9%, and the sample is 10. So taking everything as a whole, the sample company is more efficient and more profitable at running their business than the template or the candy making business. So with these percentages, we're able to make a comparison, even though it's a completely different industry. It could be completely different companies, and of course the revenue is about 8 times. There's a differential of about 8 times, but these percentages help to make a comparison. So with that, we have reviewed the common size income statement. So in the next video, we will get into the income statement in the template, and we'll get into the projections for years 2 and 3. Like and comment if you enjoyed the video. Please subscribe, and thanks for watching.